Good afternoon and welcome to FTE's webinar, The Economic Implications of COVID-19, an update presented by Professor Scott Baier. It is now 6 p.m. Eastern Time, 3 p.m. Pacific Time, June 10th, 2020, and we'll now begin recording the webinar. As part of the Foundation for Teaching Economics efforts to promote excellence in economic education, I'm pleased to sponsor this follow-up seminar to Professor Baier's original presentation 6 weeks ago. I'm Ted Tucker, Executive Director of the Foundation, and it's my pleasure to introduce our speaker today, Professor Scott Baier. 6 weeks ago, Professor Baier provided an excellent analysis of the economic implications and policy response to COVID-19, particularly actions by the Federal Reserve and Congress, and the likely efficacy of those policies. Given the rapidly changing economic conditions in the United States, we asked Professor Baier to provide an update on the current state of the economy. Professor Baier is the chair of the economics department at Clemson University and has been a longtime professor in the economics leaders program. And we're grateful for him giving today's presentation. Following the presentation, we'll have 10 to 15 minutes for questions. So please use the Q&A feature. And then following the presentation, we ask that you complete a short survey of the talk. So I'll turn it over to you now, Professor Baier.
Thank you for that introduction. And again, thank you for having me here again this evening or good afternoon in the afternoon for the people on the West Coast. So this lecture today is going to capture a lot of things that were in last lecture. So there's going to certainly be some overlap, but really what I intend to do in this lecture is tell a economic story with data where I don't really rely on supply and demand graphs to tell the story, but actual data and understanding that behind all the graphs that I depict or all the charts of data I depict, there are the essence of supply and demand going on, and I'll give some hints about what's going on. So probably most of you or many of you have seen this website or some website that's like this. This is the Johns Hopkins website that updates incidences of coronavirus in the United States and around the world on a daily basis, both in terms of confirmed cases, recoveries, and deaths. Unlike this type of data dashboard, economic data doesn't normally come to us in such high frequency or daily in some sense. Most economic data, like GDP, comes to us comes quarterly or yearly. Even what we consider high frequency data, the useful high frequency data, is monthly data. So as COVID-19 evolved, we had to turn to alternative data sources to observe what was going on in the economy and to make policy prescriptions related to what we were observing in front of us. So what I am going to do here is look at some of this high frequency data and kind of discuss how it was used in the economic stories behind that. And again, how these data and how what we observed and helped inform the government policy that we saw. Probably the easiest high frequency data that comes to us in economics on a daily basis is the stock market. And so what I've done here, and I had a similar graph last time, is I take the Dow Jones Industrial Average and the S&P 500, and I started at the beginning of the year and I benchmark each of these data sets to being 100. So any movement along this line we can think of as the percent change from the beginning of the year. So you can clearly see the two data points I've highlighted here, where the Dow Jones dropped to 64.4. That means it was down almost 36% from where it was at the start of the year, and the S&P 500 was down over 20% at the start of the year. And we can kind of observe how COVID-19 or the coronavirus impacted the financial markets, and then we'll talk again how then it spilled over and how that impacted the real economy as well. So I think the first kind of data point that when we knew that the coronavirus was going to impact the United States in a way that was different than what we thought at the beginning of the year was on February 24th, where we had the largest drop in the Dow Jones in more than 2 years. And this came on the heels of fears of COVID-19 occurring in the US much larger than what we had anticipated. The next big date that I wanted to highlight, I think, came on March 12th. This was the day after the NBA, Major League Baseball, and NCAA postponed or pushed off the rest of the games. Again, this sent a signal or a shot across the bow in some sense that large gatherings of individuals were no longer going to take place, and the whole idea of social distancing would again soon come into our everyday vernacular, something that we may not have uttered before the date of March 12th. But again, following that date, the stock market had a dramatic drop. The next big date I think that's important is as we get close to where we were at the bottom of these two stock indices for the year was on the date of the passage of the CARES Act on March 18th. Again, so this kind of signifies that government stimulus or government actions were in place and that they were intended to help the economy. And then the last two dates I want to highlight, and again, these dates aren't set in stone, so I use a little different color here, you think of these dates that were around March 17th, March 19th, and then, March 19th to March 23rd, and then beginning early in May, that March 17th and March 19th date was highlighting the beginning of states having shelter-in-place orders. And some states did it earlier than others, but then beginning in May was when we saw states start opening up again. And so really what you could start to see here, and it'll be a story that I tell throughout, is after the passage of the CARES Act and after closing down of the economy, we started to see, at least here in the financial markets, some improvement in the financial markets to the point where we were 2 days ago, where the Dow was just 5% under where we were at the start of the year, and the S&P 500 was almost right back to where we were. Again, so we go back to what was the whole idea of flattening the curve and shelter-in-place orders, or what do we mean by flattening the curve? The idea of flattening the curve from an epidemiology standpoint was what we were concerned with at the time was the healthcare capacity of the economy, that since we didn't have any treatments, any vaccines or prophylaxis, it could be the case that the disease spread widely through the population, the healthcare capacity of the economy would be overrun, and we'd have higher death rates than we thought. So one idea of flattening the curve was, or sheltering in place would be, we limit the contact with individuals, it slows down the spread of the disease, kind of spans things out over time, so the distribution has more of a flatter shape to it, so the healthcare capacity didn't get overwhelmed at the time. But economists also argued, along with flattening the curve, what we would likely see is resources being rallied around an expansion of the healthcare capacity, where hotel rooms would be transformed into hospital beds, and you could bring other doctors in. So at any point in time or any place in time, you could expand the healthcare capacity if you had enough time. And I think if you look around, to a certain extent, we've observed the expansion of the healthcare capacity of the economy. From an economic standpoint, we also realized that flattening the curve would have an impact on the economy as well. Of course, if we did nothing to flatten the curve, and so down below this axis almost looks like a shadow, what I'm trying to depict is how deep a recession could have been. If we did nothing to flatten the curve, certainly the economy would have gone into a recession, and it would have probably been exacerbated by the larger numbers of deaths than what we would have had otherwise. However, by having shelter-in-place orders or people deciding to social distance on their own, what you're likely to see is a deepening of the recession than what you would have had otherwise. So most likely the economy was going to go into a recession sooner, and it may be deeper and may last longer. Those questions are still unanswered, but certainly the economy, is what I'll show in pictures, went into a recession much faster than we thought we would have otherwise. And by the way, just yesterday or the day before, the National Bureau of Economic Research, which is the official dating body of when a recessions occur, have now dated this recession to have begun back in February. And I think, again, that was due to the onset of COVID-19 and then the response. Well, what impact was this going to have on the economy? But by social distancing or sheltering in place, remember that nearly 80% of our GDP comes from the consumption of services. And most services that we consume come from face-to-face interactions with individuals. So basically what was occurring when we had shelter in place or designed social distancing was we were going to reduce drastically services consumed in the economy or reduce drastically 80% of GDP. And to an extent, this is what we saw. And now what I'm trying to do now is bring more data into this talk than I had last time. So here are Apple mobility trends beginning at the first of the year and going to the end of March. And what we can clearly see here, most modes of transportation, whether it be driving, transit, or walking, began to stop abruptly in early March. And I also think it's interesting to note, if you look here, that mobility really began to reduce itself even before you had states implementing shelter-in-place orders. That is, it is quite natural to expect individuals to respond to incentives. In the sense here, the incentive was, if I go out and interact with people, I'm more likely to catch COVID-19. I may give it to my family, hence I'm going to be less mobile. So even before we had the state mandated shelter in places, we saw individuals becoming less mobile. So how was that going to impact, again, this lack of mobility or reduction of mobility? Where was it going to show up? Well, again, it's going to come mostly on the consumption side from consumer spending. Remember, consumers are 2/3 of total GDP. So if we stop going out or going to stores and buying services, where is that going to show up? So what we saw, or what we've seen over the first 4 months of COVID-19, is roughly a 16% drop in consumer spending from where it was earlier in the year. We see certain industries like entertainment dropped nearly 70%. Consumption at restaurants was down well over 50%. Transportation over 65%. Again, think of nobody's flying, nobody really not driving to vacations anymore. So again, a reduction in transportation. And then a reduction in healthcare services that we bought. And that almost seems counterintuitive that we have this healthcare crisis, yet spending on health services went down. But remember, people weren't going to the dentist, they weren't going to the eye doctor, and we had many other elective procedures delayed until we knew the hospitals weren't going to be overrun. So again, we even had a reduction in healthcare services. Not surprisingly, the only area of consumer spending that we saw a large increase was in grocery store visits. So again, remember that consumer spending is people going out and buying goods and services. And remember that labor, we often refer to in our FTE and in our economics classes, is labor is derived demand. So if people aren't going out to restaurants, well, reduction in number of people going to restaurants, you're going to have fewer workers in the restaurant industry, fewer workers at movie theaters, working at concerts. So we're going to see a reduction in workers in all those industries. And certainly we saw this occurring almost lockstep with the reduction in consumer spending. So this data was provided to me by the company Homebase, and I've broken up a few industries here, and I'm just going to highlight a few of them. Again, notice the pattern of the data. Right around early March, mid-March, we had a large reduction in hours worked in many of the same industries in which consumers stopped spending. So we had large reduction in spending on beauty, on beauty and personal care, entertainment, food and drink. And the only one that kind of stayed up that we think of as a service that kind of stayed close to where it was this orangish line here, which is home repairs. And again, I should point out here that I end this data right around the end of April. So this is right before the economy started to open back up and right before all the government policies that were designed to help promote and sustain the economy began to have its impact. And so what I'll do a few slides down the road is show how those government policies and the states opening back up, how it kind of reversed these trends here and how we see that in the data. So again, what we see here was this dramatic drop in early March, and then kind of a leveling off, and think of this as the period in which individuals were sheltering in place and practicing social distance, again, either mandated by the state or on their own. Another thing that we can observe, again, using alternative data, this comes from ADP, which collects lots of payroll data, is what was going on in firms. And the thing I would like to highlight here, it was mostly relatively small firms. That is, firms that had, say, between 1 and 49 workers, where they had the biggest employment impact or the biggest reduction in work hours. So again, there's two categories here. There's paid employment. That means all workers who stay on the payroll, even if they didn't work that week. So they may have been on furlough or laid off, but not officially, but still on the company's payroll. Or active employment. And here you see, for example, in firms that had 1 to 9 workers, workers that were working some hours had a 20% reduction in hours worked over the week. So again, one of the things I want to highlight here, and one of the things that we were observing at the time and early on, it's confirmed as we compile more data, it was relatively small firms that were impacted the most in terms of employment changes by the onset of COVID-19. Another way to look at it is, again, this was data provided by Homebase, looking at the same type of industries, say beauty and healthcare, food and drink, fitness is what we saw of businesses openness. Again, we had a drop off of the number of businesses open in early March. And again, you saw, again, for example, beauty and personal care, about 80% of those businesses were closed by the middle of March, the beginning of April. Similar for leisure and entertainment, and food and drink was down 50%. So what I'm trying to highlight here, that there was a big drop off in consumer spending on a lot of these services. That was transferred into a lot of businesses shutting down, and a large increase in unemployment and fewer hours in all of those industries. So then switching things over to data that we normally look at, and we knew it was going to be bad, but we had no idea how bad it was going to be. Back, I remember when I gave my first talk on COVID-19, and on, I think it was March 20th, we knew the weekly unemployment claims were going to be released the day after my talk, and we were anxious to see what those are. And so what are weekly unemployment claims? This is the weekly number of people across all states who file for unemployment insurance, that is, to collect some unemployment benefits. And so what I've depicted here are unemployment benefits in what I would call more or less normal times. When the economy is doing well, roughly every week, about 280,000 people to 300,000 people will file for unemployment claims. And then during recessions, which I've highlighted here, you can see the Great Recession from 09 to, I've kind of made it a little bit longer than what the recession was, but what you can see here clearly and what you would anticipate is that during recessions, there's a peak up or a jump up in weekly unemployment claims. And so the largest one here over this time period there was an increase in unemployment claims of 665,000. So again, I ended this the first week of January. If I add in the last few months, what we're going to see here is how COVID-19 or coronavirus's impact on the U.S. economy literally turns these mountains into molehills. So again, here's the same picture. Here's the Great Recession. Here's the recession in early 2000 and the recession back in the 90s. Same picture as before, but all I've done here is I've added in these last, say, 12 weeks here, which captures the weekly unemployment claims. And if we kind of zoom in on these, what we could see here was an extraordinary increase in the number of people filing for unemployment. an order of magnitude larger than the largest number we had seen again since 1990. So the second week of, say, the COVID-19's impact, we had more than 6 million people file for unemployment insurance. The following week, again, we had over 6.5 million people filing. So again, an order of magnitude bigger than anything that we've seen. Over the ensuing weeks, though, we kind of noticed that, again, the people filing for new claims for unemployment insurance were falling over time, but again, haven't returned to some level of normalcy yet. We're hoping that maybe by June, maybe late June, July, or August, we get more data that looks more normal, but it's been a slow path down from 6 million down to under 2 million. And again, if you look at the additional numbers that came in on the number of job losses in March and April, not too surprisingly, they occur in the industries that we would expect them to occur in. So in leisure and entertainment, there were more than 8 million jobs lost. In education and health services, there were almost 3 million. Most of those were in the health industry. In retail trade, we were down over 2 million. Construction and manufacturing, both were down over 1 million. No industry here had any increase in employment in March and April. And so what I did was I combined the March and April job losses. So a little later in the slide, we're going to look at what happened in May and how things look a little different from that. So now looking then at the unemployment rate, we can look at the unemployment rate, looking at it over time, and we see going back, you know, as far back as we can go, reasonable data. Going back to 1948, we see the unemployment rate peaked at 8%, almost 11%, 9%. And then in April, it reached 14.7%. So again, we've never had a increase in the unemployment rate occur so dramatically. And one of the slides I took out to save some time, it's usually the case that during a recession, the unemployment rate peaks after the recession is over. In this case, it looks like the unemployment rate may have peaked within the first or second month of the recession. And as I'll show later, and as you may already know, the unemployment rate has already started to go down from where we were in April. So May's numbers were an improvement. Again, to give some idea of how different this shock was to the economy than any other shock that we have observed, I depict this other series here. It's called the JOLTS series, which captures hires and separations in the economy. And again, I did not include the period of COVID-19 because, again, I want to highlight just how different this is. So again, the easy way to think about what goes on during a recession is it goes almost against what our conventional wisdom is during a recession. So here's the Great Recession. So what we typically think of that, you know, during a recession is what normally happens is that firms lay off a bunch of workers. Actually, for most recessions, that's not what occurs. What really happens during a recession is the hiring rate falls dramatically. And so firms aren't absorbing the new workers. It's not so much that they're letting other workers go, it's the rate of hiring slows down. And even separations, which are job quits and job quits and firings, those also have a tendency to decline in a recession, but not nearly as fast as how quickly hiring drops. And again, I should make one other quick point about this graph is during good times, and I'll call this a good time in 2005, what this represents is that roughly during good times, every month, the US economy adds about 5.5 million jobs, and every month we lose about 5.3 million jobs. So again, that difference of 5.5 million and 5.3 million is a net job creation of 200,000. So when you hear at the first Friday of every month when the jobs report comes out that 200,000 jobs are created, what it really masks is this large difference here between the number of people that were hired, well over 5 million, and the number of people that were fired. So again, this is kind of how the economy looks like when it's performing normally. And this is what it looked like. Again, same picture. I've just added in the impact of COVID-19. Unlike almost any other recession we had, separations increased dramatically and hires dropped quite a bit like we would expect, but not nearly as much as separations increased. So again, during the month of April, this is the most recent month we had, separations, that is quits and firings, mostly firings or layoffs, increased by 9 million and hirings fell by about 650,000. So a big increase roughly in a slowdown in the economy of hiring of almost 10 million individuals. And we see this in our separation hires data. Another way to think about separations, again, kind of highlight what a normal economy looks like, is that the red line here represents layoffs, and think of that as people being fired or let go from their job. And notice during good times that firings are about 2.5 million. Again, it doesn't vary much. We did see a little bit of a spike in the Great Recession. But the one thing that's interesting and the one thing the economists pay a lot of attention to are quits, and quits are the black lines. And so if there's one thing that the economists like are quitters, because we think in a sense when it comes to labor market activity, quits are a sign of a healthy economy. That is, I'm only willing to quit my job if I have a better job offer. I think I'm going to have a better job offer, or I already have a better job offer. Again, so this is what a normal functioning economy looks like. And this is how the economy was doing quite well coming out of the Great Recession and performing quite well in terms of labor market. Quits were going up, which means workers were optimistic about finding another job. Again, if I add in the last month here, what we see here is, again, a dramatic change in labor force dynamics. Layoffs increased by 9.5 million. Again, normally, layoffs don't spike anywhere near that. And the other thing fell, as you could imagine, other thing that occurred, as you could imagine, is quits fell by roughly 650,000. Again, thinking intuitively, I am not going to quit my job if I don't think I'm going to have a chance of getting a better job. So again, what we saw here was a dramatic change in the economy than things that we have witnessed in the past. So again, kind of taking those data slides of what was going on in end of February, March, and into April, we can now begin to think about what policy should look like and how it should be formulated. So again, what I'm going to say is this time is different. It's much different than the Great Depression. Remember, the Great Depression started as a financial crisis, which also had many, especially initially, flawed policy responses that exacerbated the recession. This resulted in persistent high unemployment, low consumer and producer confidence, which again exacerbated and prolonged the Great Depression. But again, it came in some sense on the financial side. So in some sense, it was man-made in a sense. It was also different than the Great Recession. Again, the Great Recession was a financial crisis, and we know that it was partially caused by mortgage-backed securities and how they were securitized and trouble unwinding, and the financial crisis made its way from Wall Street to Main Street. It was also different from the crisis that we saw and the recessions that we saw in the 70s and 80s that were typically due to supply shocks, and they were due to a sharp rise in the price of oil. And at that period of time, the US was much more of a manufacturing-based economy. So when the price of oil went up, it made production costs go up, and that slowed down economic activity. Prior to this pandemic, none of the above were true. The financial markets weren't in trouble. In fact, banks were in very good shape, both because, in some sense, because of regulation and because of better management. Real GDP growth was strong, buoyed by consumer spending. Consumers had deleveraged a lot of their debt that they had back in the Great Recession, and they were spending more, kind of helping driving the demand side of GDP. As we know, unemployment was low, 3.5%, and inflation was low. And so sometimes we refer to this, or economists refer to this as the Goldilocks economy, where we had strong real GDP growth, low unemployment, and low inflation. Things that we typically care about were all moving in the right direction. In addition, we had lower oil prices, again, which was supporting consumer spending, making their budgets go a little bit farther. So again, what I'm going to emphasize as I talk about policy a little bit is that going into this Great Recession, Yeah, there were some issues in the economy, but generally speaking, from a structural standpoint, the US economy and the world economy were in pretty decent shape. So this COVID-19 or the coronavirus should first be thought of and foremost as the health shock. It's going to have large supply and demand side effects. On the supply side, we know initially it disrupted supply chains. That is, goods being assembled or shipped from China or other places in Asia, that slowed and disrupted those supply chains down. So it had supply effects, but it also had demand effects. It was going to limit market transactions because people stopped going out and buying stuff either by choice or by order. It was also different than the Spanish flu. And I get asked this quite a bit. Well, why isn't this the same as the Spanish flu? And one of the main arguments for it, why it was so much different, is because the structure of our economy is so different than what it was in 1918. Again, where our economy is now 80% services. Back then, we were more of an agriculture and manufacturing base. So again, we didn't rely on person-to-person transactions as much as we did now. So again, the nature of the structure of the economy was different, maybe not the nature of the shock. So then what should the government response be? And so I'm going to go through the slides quickly of both the fiscal and monetary response, but given what we've seen, you can think again intuitively of what's going on. First and foremost, it's a health shock. And so what we would like the government to do, at least the fiscal response, is to respond to the sector that is impacted. And if we could fix that sector, then we know clearly that the economy is likely to do better. In addition, we should provide income support for lower income individuals or the most vulnerable, provide support to maintain employer-employee matches. Again, why was that true? Because why do I state that, I should say? Because remember, if we think the structure of the economy was sound, employees, generally speaking, liked where they were working. They wouldn't have left otherwise. So what we want to do, and what was different, I think, about the policies that were rolled out here, the policies rolled out here were designed so that firms would maintain their employees. And then, of course, there was some notion is you wanted to provide support for the sectors that were most exposed to the shock, not through any actions of their own, just because they were the sectors that were impacted. So again, quickly going through the fiscal timeline, we could break it up into really 3 different phases. Phase 1, almost little impact. It was a simple 8.3 spending on research and development on COVID-19, some expenditures on public health and medical supplies, and a few other tweaks here and there. A relatively small bill in early March, again, to say, hey, we're going to be rolling out fiscal policies to address the issue. Phase 2 was the family first. This is on the next slide. I'm going to skip that slide, so I'll briefly talk about it here. Again, this Family First Act was designed, again, to address the healthcare aspect. It provided paid sick leave so that workers would, if they were sick, they wouldn't feel like they had to go into work because they needed the income. They would stay home, take care of themselves, again, so that those individuals would isolate themselves, and provide additional family medical leave. So if my son or my daughter or my spouse was sick, I could stay home with them and I could tend to them, and I wouldn't have to worry about going into work and potentially spreading the disease. The Family First Act also increased COVID testing, and it also led to an expansion of unemployment in terms of duration and generosity of the benefits. The CARES Act, which was passed really 4 days later, really is one of the more important things that was done here, that kind of to address the economic issues rather than the health issues. That provided the household payment, support for small firms, support for medium-sized firms, unemployment insurance, and aid to the states. I'm going to talk about that in a little bit greater detail. Phase 3B was simply an extension of the CARES Act, because quickly we ran out of funds for the support for small firms, so they had to go back and increase the amount of funds in that bill. So again, you skip through that. I discussed that in a fair amount of detail. The CARES Act, what did it do? Again, it had direct payment to households of $1,200 for every adult, $500 for every child. Again, it's similar to the 2008 rebate, but its purpose was different. The 2008 tax rebate was designed to have people go out and spend more money, again, being a stimulus package. The design of this program here really was designed and to provide income support. So we knew that people were going to be losing income. We didn't want people to run out and stimulate the economy. In some sense, that's the last thing we wanted to happen, because it could potentially increase the spread of the disease. Second important thing of the CARES Act was the small business loans, often referred to as the Paycheck Protection Program, or PPP for short. It was designed for firms that had less than 500 employees and designed to cover really 8 weeks of payroll. So again, the key thing about the design of this bill was it was designed to maintain that employer-employee match, so that if I kept my payroll as it was and kept my employees on payroll, I could write down, in many instances, the entire amount of that loan from the government. So again, this was kind of a new fiscal economic response that we haven't seen done before. I think it was done for the right reason. It was to help stabilize employment when firms were more likely to let firms go. And then there was the Economic Stabilization Fund, or the Main Street Lending Program, and that was $500 billion, designed for medium-sized firms. It was designed for state and local municipalities to provide support for them, and then also to provide support for those industries that were impacted. So again, that was the idea of this CARES Act, was to target small firms, medium-sized firms, and we know state and local municipalities are going to have a reduction in tax revenues and are going to have very tight budget situations, and those things were going to need to be addressed. And they probably will have to be addressed again at the end of the month, and I'll have some parting statements about that. And again, they also expanded unemployment benefits in terms of duration and in terms of generosity. In fact, just this week, or maybe it was at the end of last week, the Congressional Budget Office wrote a memo to Congress saying that under this expanded unemployment benefits, 5 out of 6 workers are actually getting paid more money on unemployment than they would be if they were working at their job. So again, there is concern of, as the economy gets healthier, are these unemployment benefits a disincentive for individuals to go back to work? On Federal Reserve timeline, I'm going to briefly go through this, but I'm going to talk about what the Fed tried to do in detail, kind of in buckets here. Is, again, on March 3rd, the Fed simply reduced the federal funds rate. On March 15th, again, Fed took action, again, doing normal things that the Fed does, and I'll talk about that on the next slide. On two to 3 days later, the Fed undertook more what I would refer to as abnormal, or some like Great Recession type programs they reinstituted. On March 23rd, they started to begin to create programs and do programs that they hadn't done in the past. And that also became part of what was done in April 9th in terms of extending Federal Reserve actions beyond just trying to maintain interest rates, or using interest rates to maintain full employment and low inflation. But I'm going to speak of each of these in buckets. And again, so the first bucket is the thing that the Fed did first. It was kind of standard operating procedures that the Fed does. And this is what it did on March 3rd and March 15th. It cut the federal funds rate, or lowered the target of the federal funds rate, again, trying to get banks to come in and lend to each other. The Fed also lowered the discount window lending, and that's what the interest rate that the Federal Reserve charges member banks to borrow from them. So it wanted to encourage banks to tell banks that, hey, we're here. If you need liquidity, come and borrow from us. It lowered the reserve requirement to 0, and it provided what we refer to as forward guidance, which was really honed during the Great Recession, where the Fed tries to set market expectations on the time path of interest rates over time. anyone listened to what Fed Chairman Powell said today, again, it was an exercise in forward guidance and basically saying, thinking about raising interest rates, we haven't begun to think about raising interest rates. So in terms of adjusting the federal funds rate, there appears to be no period down the road in which the Fed, to the end of 2021, most people speculate, is not until when the Fed will begin to consider raising the federal funds rate. But following those initial reactions, the Fed observed this demand for liquidity. And how did the Fed observe this? Again, looking at data, we could see what the Fed did. So usually during the beginning of a recession or any downturn in the economy, there's usually typically what we refer to in financial markets, economists and finance people think of as a flight to safety. That is, they want to hold safe assets. And so U.S. Treasuries and U.S. bonds are relatively safe assets. So if you remember from your finance courses or your economics courses, that bond prices and interest rates are inversely related. So when there's an increase in the demand for bonds, it bids up the price of bonds, which lowers the interest rate. So again, kind of one of the key dates I highlighted before was February 24th. What we saw over this period from February 24th to early March was this flight to safety. Again, people wanting to hold safe assets. At the middle of March, or what I've highlighted here, the Fed noticed interest rates were starting to spike up, not only in U.S. Treasury markets, but also in other financial markets. Again, what the Fed believed is that people were scrambling for liquidity. There was a demand for cash. And then the Fed reacted by doing similar things that they did during the Great Recession. So this is kind of the second bucket of activities that the Fed did. So again, right around March 15th, they said we're going to increase securities purchases. Basically, this is reinstituting quantitative easing, though they didn't call it that. Also on the 17th of March, the Fed relaunched another Great Recession program, the Primary Dealer Credit Facility program. This is where it lends to the 17 large investment banks, making sure that those investment banks had access to liquidity. They also noted that money market mutual funds were seizing up. This was households and small firms who participate in money market mutual funds. They noticed there was a demand for cash, so they said they would step in here and provide more liquidity. And then again, they entered more engaged, I would say, in the repo market. And the repo market is overnight loans. So normally these overnight loans are overnight and relatively small, 100 billion typically, small to the Fed. During this week, the Fed announced that they were going to be willing to lend at least $1 trillion in overnight loans, and would offer $500 billion in loans up to 1 month to 3 months. Again, it was a relatively small program before that, but again, trying to provide liquidity to the markets as people were demanding cash. And so what we could see here, again, there was that date, February 24th, that run to safety, this demand for cash, and then these liquidity actions by the Fed stepping in and lowering, providing liquidity, and then we saw the financial markets kind of return to normal at this point. The next set of actions is the Fed undertook were something new that was basically joint with the CARES Act, in which the Fed began to really almost directly loan directly to firms, and it's something that the Fed has never done. So the Fed created the primary market for corporate credit facility. Again, this allows the Fed to directly lend to corporations by buying up new bonds that they issued. Typically, the Fed could only do that on the secondary market. Now they could do it on the primary market as new bonds were issued. Again, a lot of small firms to medium-sized firms, they finance a lot of their day-to-day monthly payments with commercial paper. They noticed that this market was seizing up. So again, the Fed said they were going to step in and be very active in buying up commercial paper. Again, lending in some essence, lending directly to small and medium-sized firms by buying commercial paper. They were then going to oversee the Main Street lending program, which is the lending to medium-sized firms, and the Paycheck Protection Program, in which this was designed for small businesses. So what we're going to do is now is to take a little bit of look at, see who was targeted here. So with the small business loans, what we could see is the percent of firms that had fewer than 5 workers. They accounted for a little bit over 60% of all loans. 5 to 9 workers were roughly 17%. So what we again see here is what I tried to highlight in the other slide. It was these small to medium-sized firms that were heavily impacted in terms of reduction in employment and employee hours working. So a lot of the PP loans were targeted, for these small to medium-sized firms. Even if you look at the, it was small in terms of percent of employment, but again, you add up to firms under 100, is a notable amount of employment. If you look at the industries, not surprisingly, it were the industries that were most impacted in terms of employment, in terms of receiving the loans: accommodations and food services, healthcare, construction, professional, technical, and scientific services. All those service type industries, along with manufacturing and construction, all that had more than 1 million job losses, were recipients of a lot of the PP funds. So these 7 industries account for nearly 75% of the PPP loans. So I often get asked, how effective were these programs, or how well designed? Well, the one thing I'll say is, Congress and the Senate and the White House came together pretty quickly to design these programs over the course of a couple weeks. They rolled them out relatively quickly. Again, they weren't perfect. Almost no plan was, but I think in many ways they targeted the right groups and the right industries, and now we can begin to assess what impact these programs had on the economy, as well as states opening back up. So going back to the charts that I showed earlier, I've now extended them to just yesterday, and what we see here, again, looking at Apple mobility trends, is, with the exception of transit, we see a clear increase, again, in economic mobility, or at least Apple mobility trends of people driving more and walking more. And again, what we see here in terms of transit, it's starting to increase a little bit, but it's been relatively flat. And again, what I think this is important kind of signify is, and I talked to my niece up in New York yesterday and said, it's going to be really slow for some of these large cities, because it's hard to social distance when you have everybody goes to work on public transit and everybody has to get to the 58th floor, the 104th floor by elevator. So how we practice social distancing in these large cities, or how we evolve to having people return to the workplaces, may look a little bit different for these dense urban populations. But again, going back to some of the other data I showed, remember how we said that we had this big drop off in business openness. We had a flat period through most of April. But what we see here is, coming out of April and beginning in May, as we see this gradual, again, pickup in terms of businesses opening back up. So again, at its nadir, what we saw was beauty and personal care were down nearly 90%. You can see by the middle of May, it had bounced back up, or it increased back up quite a bit. Again, well below where we were at the beginning of the year in terms of the percent of businesses being open, but a lot better than what we were early in the year. In response, as people are going back out, the people are consuming more, businesses are opening back up, we're seeing hours work, again, move in the same direction. So again, in these industries, these service industries that were most heavily impacted, what we're seeing now is hours worked are down, but not nearly as down as much as what they were. So again, as the economy opens back up, what we're seeing is people being brought back into the workforce. And so you could look at here, this chart I put together is kind of the difference from what I would say is almost the bottom for all of these industries and where we are today. So in beauty and personal care, at the worst, we were down over 85%. Now it's down just under 50%. Food and drink was down 65%. Now it's down roughly 40%. So again, the economy is, as it opens back up, we're showing some signs of recovery. But when these service industries were far away from where we were, at the start of the impact of COVID. Last Friday, we had the jobs report numbers. And so we had the new numbers for non-farm payrolls in May released. And again, caught most economists, both business economists and academic economists, by complete surprise. Most people were expecting another large decrease in the number of workers and a large spike in the unemployment rate. But much to our surprise, actual non-farm payrolls outside of the government increased by almost a little bit over 3 million. The biggest gainers, of course, were where you would expect. They were in the industries that, one, had lost the most, but also the industries that were beginning to open back up. So leisure and hospitality showed pretty big gains. Education, and that should be health services, not HELAS services. As health services, as doctors and dentist offices opened back up and people started having other procedures done, again, there was a jump up in workers and healthcare services and business services. And then manufacturing and construction both rebounded quite a fair amount, about a quarter of the jobs that they had lost. So again, kind of looking forward is, as I would say, as other states open back up and as other states are open, as they expand, how many their seating or occupancy, we'll again see these numbers likely tick back up with the next job report. So again, what we saw in the unemployment rate was it peaked at 14.7%. May numbers came in and surprised us. We had a lower unemployment rate than we expected. But, at some point, someone once early on in COVID-19 commented that COVID-19 or coronavirus was the great equalizers. In many cases, that's far from being true. Some of the health studies have showed that certain age groups and certain parts of the population have been more impacted than others. We also see this when we look at the unemployment number. So even though the unemployment rate had moved in the right direction, one thing that we've observed is if we look at the unemployment rate by gender, what we can see is that COVID-19 has impacted women much more than men, whereas you look at the Great Recession, because a lot of the jobs were in construction industry, which were had a higher percentage of men working in it. The unemployment rate of males spiked higher than of women. And conversely, the impact of COVID-19 impacted sectors that have a higher percentage of women in, so their unemployment rate had spiked. So it's going to be interesting not only to watch the headline unemployment numbers, but also what happens to unemployment by gender and unemployment by race. And so the one kind of, in the initial look when I thought was, oh, this isn't a good sign at all, is that the unemployment rate, well, almost across the board in almost every category, the unemployment rate went down, except for the unemployment rate for Black or African Americans as it's listed by the BLS. That actually ticked up a little bit. But when you took a deeper dive at the numbers, one of the reasons why it ticked up was because more Black African Americans went back into the labor force looking for jobs, and that increased the denominator. So there was actually an increase in employment, but you had an increase in labor force participation. So that increase in the unemployment rate is, you have to look at that with a little bit of a jaundiced eye, because there were two things going on. An increase in workers, but also an increase in the number of individuals looking for jobs. Then last thing, we always have to be a little bit careful of and pay attention to is what's going on with the unemployment rate and these alternative measures. So kind of the headline is just the number of people who are actively looking for a job. It doesn't consider individuals who have been cut back in terms of hours worked, or maybe working at a job that they wouldn't want to do otherwise. So we have this other labor force measure called U6, which is more encompassing, which captures reduction in hours worked. And again, if you go back to the earlier slide, you see a lot of individuals who are working in the service industry, they're still working, but they have a reduction in hours. So again, what we see when we look at this measure is we have an unemployment rate that went above 20% and it remains above 20%. Again, what we'll have to observe is how it moves as the economy opens back up and if there's additional fiscal response to it. So, question that often comes up, as I'll try to wind things down a little bit, is how are we going to pay for this? The deficit at the beginning of the year was expected to be about 4.9%. Now it's likely to exceed 10% of GDP. And if there's another fiscal package, it's likely to be above 20%. That's a typo. If there's likely to be another fiscal stimulus, it'll be much higher. So the good news is that interest rates are relatively low, so we can borrow on the cheap. Bad news is the long-term budget outlook for the U.S. economy was already a mess in terms of where we were heading in terms of discretionary and mandatory spending. This is just going to make things worse. In fact, by the end of the year, the debt to GDP ratio is expected to be over 100%. That puts us about 5 years ahead of where we were, the CBO had us projected to be. So again, it moves the timeline up of when we're going to have to do something about budget deficits in this economy. So questions I often get, well, what will the recovery look like? What sectors will recover the fastest? Well, what I would expect are that offices and factories are going to be the first to open up with some social distancing, and to a certain extent, offices will have many of its individuals to continue to work from home. I know YouTube and Google, or their offices in New York, said we'll see you January 1st at best back in the office. You can assume that you could do your job at home until then. Amazon, I believe, is not considering opening back up or having workers back up until mid-September to October. Again, so how office work may be a little bit different. Small retailers with limited consumers is what we'll see as places open back up. And again, as I've said on a couple of other these lectures, it's interesting as I go through, being in South Carolina, as I go through into either grocery stores or other places that open up, I take mental Yelp notes of not only, do I like the goods and services provided by this retailer, but also are they taking precautions for my health and the health of the workers. And when I leave, I'll say, well, this is a place I certainly want to come back to. And then this is a place where I may not want to come back to. And again, this is where I think where we're going to rely on the innovativeness of businesses, because there's a lot of heterogeneity or differences in businesses, even within the same industry, given their store layout or the customer base they serve or where they're located. So they're going to have to respond to these health issues much different than even a store in the same industry. Barbershops and beauty salons and eye doctors and dentists are slowly opening back up. Restaurants are opening back up. And then lastly, what we'll eventually see are events with large crowds. And so now we're starting to see sporting events without fans, and there's some talk of when fans will be allowed either back in. I heard there was a golf event coming not too far down the road where they're considering having socially distanced fan base. Of course, you have to, with any shock, there's going to be, that hits the economy, that there's going to be winners and losers. Again, I think the winners here have been some people involved in the technology sector. Again, take Zoom, for example. Their stock has skyrocketed. In fact, their stock actually fell a little bit on last Friday's jobs report as the economy looked like it was doing better. Also, I think the other winners there are those occupations or those individuals who technology allows them to work better from home. Winners are going to be industries that adapt the fastest or businesses that adapt the fastest. Again, I trust that many firms and entrepreneurs out there will respond to this shock, making it a safe environment for the workers. The negatively impacted are typically, sadly to say, are going to be those individuals with lower educational attainment, or those working in sectors where it's easier for automation or working at home or to reduce, in some sense, this face-to-face contact. Energy markets have been impacted, though they've rebounded quite a little bit. And what we might see is some structural change. So more investment in public health. We might see, again, a structural change, and again, more dial-in, phone-in healthcare. What are airlines going to look like? I hear airlines, flight reservations are up quite a bit over the summer, but still down 80% from where they were last summer. How much more are we going to do by teleconferencing, and how much more is going to be done by telecommuting, telemedicine? I think all of those are where we may see some structural change in the economy. But I think the most important thing to say is that the quicker we move to the other side, remembering that the economy was in fairly good position before we went into this crisis, the quicker we can get to the other side, the more we'll preserve that and the less structural change that will be in place. And so that's kind of, this will be my parting shot is I'm often asked to say where we're going to be 4 months down the road. And it really depends on where we are in terms of addressing COVID-19, in terms of, do we have treatments? Do we have prophylaxis? Do we have a vaccine? Have we implemented additional measures that would allow for, again, the safety of workers, the safety of employees, and the safety of consumers? So kind of, again, an epidemiology chart that has the fatality rate of different diseases, where you can see the bird flu had a very high fatality rate. And then down on this axis is how many people catch the disease for every person that has it. The thing about coronavirus, while it's this kind of shaded area here, still we don't have, there's still a lot of unknowns. While it's not all that fatal, certainly more fatal than the seasonal flu or the common cold, it does spread relatively easy. So again, the economy will rebound the quicker that we can move where coronavirus is on this chart down into this area of say, the seasonal flu. And again, that will only come by improved measures of social distancing, where it doesn't spread as easily from person to person, or again, by treatments, prophylaxis, or a vaccine. But the quicker we get to below 1 or down in this range, the economy won't get back to where it was until then. So if I'm going to make some prediction of where we're going to be by the end of the year, and I spent most of the talk on employment, I would still expect the unemployment rate, as we continue to move in this positive direction, again, without a second wave, we would still be around, say, between 8 to 9% unemployment by the end of the year. And real GDP growth over the course of the year will probably be down between 5 to 6%. And again, that's replicating, or me just stating what I think the consensus view is. So again, I've gone a little bit over time, but I'd be happy to stay on as long as you are happy to stay on and take as many questions as possible. So again, I thank you all for joining me this afternoon or this evening, depending on where you are. And again, thank you for staying with me for this entire hour.
Great. Thank you so much, Scott. I love the new slides. Very informative. We've got a series of questions for you.
Sure.
And Teresa asked, is there anything you think the government could have done better or differently to mitigate the economic impact of COVID?
I think the thing that has rolled out slower than I would have liked, it would have been the Main Street lending program. So that would have been the pure economic side of trying to get more money back to states and municipalities and support medium to large size firms. On the health side, of course, you could always say that we could have and should have done more up front. But when I have a hard time pointing fingers at any one person or group of individuals, just because of my work that when I was working in the White House during the Great Recession, that how slowly that unfolded and how slowly the policy response, both under the Bush administration and the Obama administration, wasn't responding to that. Basically nobody heard of COVID-19 until the 1st of January. It wasn't, China didn't, there wasn't even known until December 31st that there was this respiratory disease in China. And it didn't reach the States until the end of January. So having programs in place addressing health and economic aspects within a couple of weeks, I thought was pretty well done and targeted in the right areas.
All right. Disney asked this question. What impact has the additional $600 on top of the 35% to 45% weekly earnings by state in the form of a subsidy transfer payment approved by the CARES Act have on the weekly unemployment figures?
Well, again, you would think, so there are a couple of things that's, in some earlier charts, it's actually led to an increase in the initial claims for two reasons. One, there's the incentive now for people to make those claims if you're going to get the extra $600 a week over the course of the time. The second thing that was new and novel about this package was it was extended to the gig economy where it wasn't before. So it's hard to make comparisons of COVID-19 to earlier periods. We know they were going to be bigger, but again, they expanded who was eligible and expanded the benefits so much to set the incentives in for people to file.
All right, we have a question here from Will. Will asked this. He says, the US had a record number of months in a row of growth until the pandemic and shutdown of businesses. Are the economic guardrails the US implemented since the last recession helped keep consistent growth over a long period of time until this outside force changed it?
Yeah, so that's actually a good question. I will say that I think the financial sector was in much better shape than it was going into the Great Recession. Again, I think that was partially by economic policy, partially done by better bank management. I think that was a fairly large player. So I think that was a nice guardrail that the banks were in position to administer these loans, to get the loans out to individuals. So that was good. The one thing that I am really surprised by, and I've seen it both there are several reasons, but both in terms of firms, households, or all in firms, households, and government, that we so many places where we're ill prepared for an economic downturn, that there wasn't some type of buffer that we had. So if there's a lesson to be learned coming out of this, I would hope that firms, households, and governments, again, have a better buffer for the next time something like this occurs.
Okay, we have a question here from Brian, and Brian is asking this. He says, you mentioned the government should be spending money on low-income people. Is this simply an altruistic motive, or is there a overall benefit to the economy?
Well, so one is, thank you for stating it that way. So I should have been a little bit more careful with my words. So one is you want to assist those individuals who are lower income. They sometimes on average have more health concerns or less ability to seek health care. So again, they're going to be more, in some sense, more fragile both economically and health-wise. Second thing is, if you look at the industries that were impacted, there are going to be industries in which many of the workers were coming from, were just minimum wage or above minimum wage. So you're really targeting those individuals.
Okay, we have a question here from Susanna. And Susanna asks, do you think there should be an increase in measures to implement supply side policy given that this was both a demand side and supply side shock to our economy?
So by supply side policies, I think there were supply side policies with the government response. In particular, the PPP programs were designed for the supply side to keep employers and employees matched together. So I could write off my funds as long as I have those workers in place at my firm. That clearly is a supply side, I would say, argument, maintaining employment and employees together.
Okay, here's a question from David. And David asked this: how does our economy now compared to the Great Depression economy when unemployment was over 20%?
Well, again, I think as of right now, I'll say is I think we're in better shape with the exception of the pandemic. I think as I would want to reiterate that the economy was structurally sound before the pandemic hit. As long as we address that health side, and it doesn't take that long, I think we'll maintain those structural things in place and be able to rebound a lot quicker. Second thing is, like as I mentioned, that the Great Depression was, in some sense, was exacerbated by some policy mistakes, where I think in general here that our government have gotten things right. So what most likely is going to happen at the end of June and the beginning of July, we would likely to have another wave of fiscal policy. We'll see if they continue to help move the economy forward. But I should say, if the pandemic, if the number of confirmed cases and death rates again begin to spike, and the pandemic stretches into the fall and into the winter, then it's not clear how many of these small businesses will be able to survive, or other businesses will be able to survive. And then you'll have a real problem, I think, with more structural issues with the economy.
Okay, Deborah asked the question, with a zero reserve requirement, will that possibly cause a run on banks?
Well, the banks also do have, so what we've observed is banks are holding lots of excess reserves. In fact, almost everything that the Fed has pumped into the economy now is being largely held at the Fed. So I think that there is an incentive for banks. Remember now, the Federal Reserve does pay banks an interest rate for holding reserves. So that works to, again, to encourage banks to hold enough reserves back so that individuals won't think there'll be a run on a bank or a bank will go under.
Okay, Matt is asking this question. Yeah, I know you alluded it to a little bit in your final charts, but he's asking, can you make an educated prediction about what the next year or two will look like economically?
Yes, again, it all depends on where we are health-wise, but I think as long as we continue to move down the road of things opening back up, and I'll refer to this morning, I was watching CNBC, and I'll trust Scott Gottlieb, who's the epidemiologist who appears on every morning. He says he thinks that it's going to be hard to shutter things down again now that we've begun to open things back up. But he also believes that 4 months, 5 months down the road, again, not only are we likely to have better preventative care, but also firms and individuals will adapt and adjust to conducting business that way. So given all of that said, and there's no large flare up, what I would expect again is that really the third and fourth quarter of this year, the economy start to exhibit more signs of positive GDP growth. Next quarter is going to look really bad. The annualized GDP growth for this quarter is likely to be somewhere between -30 to -50%. again, look really dreadful historically, but third and fourth quarter will look quite a bit better. Like I said, 8.5%, 9% unemployment by the year. A good year in 2021 will look like 5% GDP growth. That would be a healthy rebound. And then the unemployment rate will slowly work its way back down to roughly 6%, but it may take us 18 to 21 months to get us back to 6%. I wouldn't bet on any of those numbers. That's an educated guess.
All right, we have another question it's a question from Will, and he says, asks, was there an impact by the PPP legislation that caused the most recent unemployment numbers to actually decrease, or more so the opening of some businesses?
I think it's too early to disentangle those effects. What I think we know is that the economies that have opened up earlier or didn't shutter themselves as much have had lower unemployment rates, and then that shouldn't be much of a surprise. So I think both factors have been at play here. Opening back up, people are starting to go back out, as well as all the efforts by the fiscal and monetary authorities to provide income and in some sense social insurance to households and firms. Both have contributed. It'll take time to disentangle those things.
Okay, Scott, we're just going to do two more questions. Here's one that I'm also really interested in. This is Suzanne is asking, what do you think will be the long run impact on inflation of these policies?
Yeah, that's a good question. And so again, the Fed is injected a lot of liquidity. Always a concern when that much money is injected into the system is how they sweep that back out once the economy starts to rebound. So I think, with respect, those are the two big issues when we get on the other side, is what do we do about the debt, and what do we do, with all the money that's either sitting in the banks or in households and firms' hands. So I think I'm taking the side of most economists. We'll worry about those things when we get on the other side, but I think we need to address the economic aspects now. But certainly inflation is a concern, I think, when the economy begins to rebound and function more normally.
All right, and here's the last question. Before I ask it, I just want to make sure that everyone knows that FTE will be posting this webinar on our website in addition to Scott's slides. So an email will go out to everyone letting you know when it's available. But the last question here is from Frank. Scott, and he's asking this: can you predict when will Clemson football have to face Syracuse again with fans in the stands, home or away?
Can I predict that? I could predict the winner, I think. So when do I think fans will be back allowed in the stadium? I will go so far as to say I think that'll happen this year. I don't know how many there will be. So I believe that game was scheduled to be in Death Valley this year, so it'll be in Clemson. I think there will be fans in stadiums this year. I think, again, there may be some aspect of social distancing, but I think we'll see it this year.
Great. Thank you very much, Scott. Appreciate it. And thank you, everyone,
Thank you all for staying on.
And coming and listening and asking Scott questions. And we also just ask at the very end, there'll be a short survey if you can fill out. Just help us determine what topics we should do for our webinars, and then, of course, give us feedback on the best way to offer them. So again, thank you, everyone. Appreciate it. Appreciate your time. Thank you. And thank you again, Scott.
Thank you. Have a good evening, everyone.